Welcome to the Keiser Report. I'm Max Keiser. Has Atlas shrugged? You decide. Stacy?
Max, before we get into the topic today, I want to say, I forgot to say this earlier in the week, congratulations on being the longest reigning Keiser on the Keiser Report.
Oh yeah, that's fantastic, isn't it? The Queen might have her 60-odd years on the throne, but we've been doing this longer than any other financial program in the history of the world.
Well, of the history of the Keiser Report, for sure. It's been almost 6 years. That'll be in November, and we have to do something big for that. Perhaps go to Brazil, because, of course, they've been downgraded to junk.
I don't really want to go to Brazil. The place is completely interesting at this moment. As you say, they've been downgraded to junk. The currency's in free fall. Gold has hit a new all-time high against the Brazilian real. So for those who think that gold is a pet rock, as it was described recently by, I think, either Warren Buffett or Charlie Munger, one of those two, certainly pet rocks are hitting all-time highs in Brazilian reals.
If the Keiser Report goes to Rio to cover the Brazilian crash, then, of course, the cost of a G-string for you for on the beach of Copacabana.
At the Copacabana.
What's that famous beach?
It's the girl from Ipanema.
Oh, I was going to say Iwo Jima.
No, that's where they hoisted that flag with the Americans. It's very iconic.
They staged it, yes. Well, we're actually going to talk about Japan. That's a good segue to Japan, because here is the headline speaking about Atlas shrugging. Nikkei's 7.7% surge, biggest one-day gain in 7 years. Japan's Nikkei 225 notched up its biggest one-day percentage gain since the depths of the financial crisis, surging 7.7% and leading an Asia-wide rally as investors pinned their hopes on prolonged monetary and fiscal stimuli. Stimuli, the FT says. Stimuli, not stimulus.
Stimuli. Well, but then, the next day it dropped pretty sharply.
But the fact is, here is our financial markets, the system in which we find ourselves, and the financial markets are now the same as the economy. There's no difference in terms of how central banks and treasury secretaries around the world look at the economy. They say the markets are the economy. That's the price, the index. The numbers on the index are our economy. So here they go wild because they're counting on not growth in wealth production, not growth in manufacturing, not anything but more stimulus from the central banks, from the treasuries. So here they're saying this is the extent of our economy, and I want to look at the ramifications of this never-ending Ponzi sort of scheme is essentially what we've called it over and over.
Well, to give you a visual metaphor of what we're talking about here. So if you take a garden hose and you stick it into the side of your house and you just turn it on full blast, the garden hose will start wildly gyrating, spewing liquidity. That's the central banks. They're just spewing liquidity into the system. But they're not doing it in any logical way that makes any economic sense. So the result is this wild fluctuation. So Japan is now wildly fluctuating, and markets around the world are wildly fluctuating up and down. There are speculators that are profiting from this. And some argue that, well, if you make the speculators rich, it'll raise all boats in the global economy. We've seen no evidence of that whatsoever. The private hedge funds and private equity firms that get rich from this, the theory being that if you make those guys wealthy, it'll increase the wealth around the world. That we've seen no evidence of that whatsoever. This whole idea of trickle-down economics, popularized in the early 1980s, has never been proven to be true in any sense of the world. But they still continue to go down that path with programs like QE, which is an attempt to feed the top to trickle down to the bottom. It's never worked yet. It's not working now, and the system is dire.
Let's compare it to what has happened around the world when the IMF and Troika sorts come in and restructure debt. And I think this is what basically the Fed, the ECB, the Bank of Japan have been doing, is restructuring debts, i.e. the terms of who's actually paying for the debts. And here's a tweet from Ben Aris regarding Ukraine debt. He says, VTB puts Ukraine debt deal in perspective. Grandchildren pay. Charts show debt profile before and after restructuring. And if you look at the charts before restructuring, it was front-loaded. So all the debt payments for their debts came today and next year and the year after. So high debts now, declining into the future when your grandchildren are in the economy. So after restructuring, the chart shows very low payments now, very low repayments now, very big repayments later. So I think what the Federal Reserve and all the intervention in the economy, in the monetary system has done, has just done essentially the same thing, is restructure the debt, extend to pretend. The extend to pretend has happened everywhere. And I think this is causing the sort of breakdowns all around the world that we see in the economies, financial markets, and societies.
That's true. Extend and pretend. And it's fueled by these constant cuts in interest rates. Remember, they were going to maybe raise rates in the U.S. at the Federal Reserve level back in March. They didn't do it. They were going to do it in the summer. They didn't do it. They were rumored to do it in September. They're not going to do it. They're going to put it off again. There's no way that they can raise those rates because it would raise the cost of servicing these debts that are compounding almost on an exponential basis. So they have no choice but to extend and pretend. And the problem is that we are at the end of a 30-year bull market in bonds that allowed you to do this type of financial engineering. Because when interest rates 30 years ago were in the 15, 16, 17% range, and then over the past 30 years, they've dropped down to 1%, 2% on the 10-year bond, you can then always count on restructuring at a cheaper rate because there is a global so-called savings glut of foreign reserves that were looking for places to park their money. But now in China, which is the biggest glut of savings, so-called, they are unwinding all that cash to defend their falling market. So as the Ponzi scheme in China collapses, they are liquidating their reserves to pay down on the debts, which is having a global impact and forcing central banks yet to ease and create more liquidity, which is a code word for create more debt.
The architect of much of this paradigm in which we find ourselves, of course, is Alan Greenspan, and he was a very close disciple of Ayn Rand, who said Atlas would shrug because all those masses of people out there, all that bottom 99%, it was they who were the sponges. And they don't give them anything, give everything to the top 1%, and somehow the whole economy would flourish. So, in a way, what that whole philosophy has become is they were self-hating sponges. They are the sponges. Nobody else is the sponge. They're the ones being sponged upon. And because of this, we're going to turn to this headline, which I think is the cause of what you see in Greece, what you see in Cyprus, the bail-ins, what you see in Japan and the US with these artificially rallies and money printing and quantitative easing and 0% interest rates. Unbanking fuels financial fallout. More than a third of the households in the Albuquerque metro area do little or no mainstream banking, substantially higher than the national average and a possible window on an underground economy and shadow world of consumer financing. So over 30% of the households, 35% actually, in Albuquerque, in the whole metro area, have no banking facilities or are underbanked, have very few financial facilities they're using. So-called unbanked and underbanked households have for years been a concern for the Federal Deposit Insurance Corporation because they illustrate a lack of public confidence in the banking system.
That's correct. And when you have a portion of the economy that's not going through the formal banking system, you have the potential to confront a portion of the population that is uncontrollable.
Yes. Well, uncontrollable. This is probably why they want to get rid of cash.
Yes.
One of the number one reasons why 37% of the population there, when asked why they don't have any banking facilities, said they don't have enough money to have a banking facility. Part of the reason is that the banks don't need their money anymore. You don't need deposits, as we've covered in the past. As the head of the central bank in Norway, or the banking lobbyists in Norway said, or was it Sweden? They said they don't need any deposits, right? They don't make any money from deposits. They make money from the Ponzi scheme. But here over in Albuquerque, which is one of the highest, and is growing across the U.S., by the way, these unbanked people who are withdrawing their money. Lots of them, though, it's just 37% who don't have enough money. The rest are just like refusing to participate participate. They're afraid of bail-ins. They're afraid of the banking system. They're afraid of all the fraud, of being defrauded by these bankers. But one of the things that makes our society work is that people have to buy in, said Daniel Yu, a chartered financial analyst at REDW Stanley Financial Advisors. Having a third of our population underserved by banks is not in the best interest of society because it fosters a subculture of people who feel the system is rigged against them and fosters a sense of hopelessness. I wonder why they feel the system is rigged against them. I just can't think how this happened.
Well, this is why there's an effort now to control money and the money grid, and it gets back to Bitcoin and the blockchain technology. Because we have now in the last few months the emergence of powerful Wall Street and city bankers who are putting forth the idea that we need to create a global currency based on the blockchain that would allow the powers that be to have complete 360-degree oversight onto every fraction of every penny ever spent anywhere on planet Earth. Because the database technology to track all that has crashed in price. The same way the NSA can track zillions of phone calls and emails through cheap technology, cheap storage, cheap bandwidth, cheap processing. They want to apply that cost efficiency to this casino gulag state, as I call it, to track every fraction of a penny ever spent on planet Earth. It sounds like a very expensive project, but when you consider the technologies involved are crashing in price down what's called the asymptotic curve, which means your price or you're going down to this price point called zero. Really, the costs are almost negligible. You then understand how this is possible, and they desire to do so because they don't want anyone out there with a $100 bill that they could go out and do anything with that $100 bill, like something that would somehow fight the empire.
But the problem with that is just like their banking system, it doesn't matter if they get a blockchain. If these people, if 35.5% of the population of metro area in Albuquerque, 27.4% of the whole United States do not believe in their system, then they don't need cash. People use little packets of laundry detergent as money. People could use chairs as money. People could use whatever they want. If they don't believe in your system, if they don't want to get on your chain, if they don't want to get on your banking system, then your system doesn't work.
That's right. The blockchain becomes a chain gang.
Exactly.
And people will resist that. They want to escape.
Exactly. They don't need to, if they don't trust in the system, they don't participate in the system. And this is what they're saying regarding Albuquerque is there's a distrust of the system. And when that percentage of the population distrusts the system, it's one of the 5 or 10 elements of a revolution. People, if they don't feel they're getting anything out of the system, then you have revolution.
Fair enough. Looking forward to it. All right, thank you.
Long reign the Keiser.
Well, thank you. And another 5,000 years to go. But just for the next few minutes, stay tuned. We'll be right back with a lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Ned Naylor Leyland of Old Mutual Global Investors. Ned, welcome back to the Keiser Report.
Thanks for having me on, Max.
So people see your face on the show and they immediately think gold. Gold, ding, ding, ding. Yes. So my first question is about gold, Ned. Let's talk about it. The S&P rating agency has cut Brazil to junk, and gold is hitting a new all-time high in that currency, the Brazilian real. Now, that's strange for a pet rock to be trading at an all-time high like that. That's
true, and it's obviously reflective of the issue with fiat currencies depreciating at different rates. I think that I'm not actually sure, but I think in real terms it's up 34% this year, something like that.
So you have different currencies. Let's talk about this a little bit. You said fiat currencies are depreciating at different rates because people, I don't think, are aware of this because, okay, gold's hitting new all-time against the real. It's already skyrocketed against the ruble. It's trading just under a high against the yen. It's trading not far from a high in the euro. So the gold is really doing what it's supposed to be doing when you have a global financial system that's kind of spinning out of control and a lot of money printing. Yeah. The only place it doesn't show up is against the dollar. So, and how do you account for that disparity?
Well, and sterling actually, but I think, Max, it's if we remove some of the outliers and let's remove real and ruble and look at some other currencies. If you look at it in sterling and dollars, what happened is that the sterling and the dollar depreciated versus gold between the initiation of QE and 2011 more quickly than it did against, let's say, more export-based economies, where the gold price was trucking along quite nicely, but it never had that big run. And therefore also it hasn't had the big deep correction. So what you see, or at least the way I'm seeing it myself, is that it depends on how financialized an economy is, how quickly and the volatility versus gold of the depreciation in that underlying currency. So as I say, if you look at sterling and dollar, big deficit economies, running big financialized systems, you see a much greater degree of volatility, whereas against the Canadian dollar, Aussie dollar, even the euro, all export-oriented economies, you don't see that same degree of volatility.
Going back, you're saying going back 10 years.
Yeah, over the course of...
Because recently that's been kind of reversed, is what you're saying.
Yes, and what I'm saying is that you just see a greater degree of volatility both on the way up and down when the economy is more financialized.
Right.
And we're in a situation at the moment where...
And going back a few years ago against these other currencies, it was not showing the volatility that we see now. So I guess the point being that anyway, the point being, Ned, that gold is still very much in the mix, whether people recognize it as being in the mix or not. People are still going to gold in times of financial uncertainty. And the demand is still quite, is the demand, do you have any recent numbers on demand? Is it still percolating at very high levels?
Absolutely. You see, well, certainly investment demand, Max, which is, of course, unfortunately, a very small part of daily trading volume. But investment demand has been growing, I think, globally, month on month without fail. And certainly in Asia, where, again, you have, you know, if you X out the yuan, you look at the other export-oriented, again, Asian economies, you would see a similar function that you'll see in the real or in the ruble, which is that, yes, gold is doing very nicely. If you're based anywhere east of Istanbul, it's doing what it should be doing. They're going through a period of currency turmoil. You can argue that financial markets here are reflecting that currency turmoil too. The fact that the markets are relatively sanguine still in London and New York, I think is probably just a function of the nature of the run-up before what we've just seen, and the fact that we've only seen, let's say, a 10% correction, which of course is not enough to make money managers and long investors really start to get nervous. But should the sell-off continue, then I think you'll see people start to think about gold again, and they'll be in a similar situation that people in Asia are, whereby they're recognizing this currency war, this competitive devaluation for what it truly is.
Mm-hmm. Now, you mentioned China there. Over the past few years, China has been the biggest buyer of gold. Now their markets are tumbling. And so there's a couple of dynamics. Another one being in their huge foreign reserve pile of various currencies, particularly the dollar. Yeah. They're drawing down on that reserve to prop up the market. And they're doing so pretty quickly. So when people said like a year ago or 2 years ago, oh, China's got $4 trillion. Well, apparently they're burning through that pretty rapidly to keep the stock market from crashing. So what's going on in gold there? Because they have been a huge accumulator of gold. They recently announced that they've revised their official estimates up pretty substantially. And so where do we see that going?
Well, look, I think the interesting thing there is we saw them do a very small upgrade to the sovereign reserve. I think that was probably something of a bit of window dressing for probably in light of the attempt to get into the special drawing right basket.
Well, it wasn't small, but it wasn't what the market was expecting.
No, well, it wasn't what we were expecting. I don't think the market.
On the show.
Well, I don't think we would certainly say that the numbers that we've seen in terms of flow would suggest that the actual accumulation is substantially larger than that. But it's also true they've been doing monthly upticks since that moment as well. So you've clearly got this phenomenon that you alluded to, which is that the dollar's being sold, gold is being accumulated. How does that affect prices covering gold? Unfortunately, not very much at the moment, because it's still the case, Max, that since the start of the Yuppie gold pool, which you benefited from in the 1980s. Well, what I mean by that is that obviously in the 1970s, we had a situation where after Nixon closed the gold window, financial markets went through all sorts of really serious volatility. I would argue substantially because of the severing of that relationship. And then the gold price basically showed up that for what it was, the back end of the 1970s. And then it seems very clear, both from the available information and just using one's noggin, that a further gold pool was established in the 1980s, which created this very, very large fractional reserve gold banking system, bullion banking system in the 1980s. So yeah, Yuppie gold pool would be a soundbite. But I think it's not far from the truth, because that helped to create the conditions for the massive financialization of the global economy.
Right. So the London Bullion Markets Association, for example, is certainly part of a system around the world to kind of manage the price of gold, if you will, in a way where the demand is not entirely reflected in the price. Is that a fair characterization?
Well, yes, I think that was a severe understatement. Yes, I don't think it's reflected at all. I mean, ultimately, it seems to be the case that the physical market probably represents 1% of daily trading volume, which is not going to move the needle that much when you're dealing with such huge capital flows against it.
Right, so let's put this in perspective. So if the physical market demand for gold would jump by 100% in a day, that would still only be 2% of all the gold traded on a daily basis if you include the paper gold.
Yes, I mean, that's right.
Right, so in other words, it doesn't matter what the true demand is for gold if it's such a fractional representation of the global paper gold market.
Well, it doesn't matter until it does matter, Max.
It doesn't matter at the moment.
Well,
it hasn't mattered
but this,
for a few
but this
years.
brings us on to this
And
point.
you've been lobbying and you've been talking about the idea that it will matter and it should matter, and that if there's any God in the universe, we can expect the date to arrive when all of the fractional gold reserve pooling gets shattered and we are delivered to those higher prices.
Well, I don't think it's unfair, Max, to use the Bernie Madoff analogy. I really don't, because I think, it's embedded in the financial system. Everyone's comfortable with it. Well, we know it might not be quite what we think it is, but we're comfortable. And ultimately, it's just about the float. And the float is a word which has been circulating in the gold world for the last week quite aggressively, because you're seeing both the futures market float diminish to almost nothing, and this very interesting article written by Ronan Manley, where he digs into the nature of the London market and what physical is available there. And
Who wrote this?
There's a gentleman called Ronan Manley. He
Ronan Manley.
Manley, yeah, he writes.
So some people should be Googling this and looking at this.
Yeah, he writes for Bullion Star.
And what's the name of this article? This sounds like a key part of this whole story. We don't want to miss it.
Yes, I know, and I should know the name of the article off by heart, Max, but I don't. But if you go on there, you'll see, I'm sure it's the latest article he's written. And it's quite long, but it goes into quite a lot of detail about what the LBMA purport to be the available gold in London.
Yes.
In terms of both Bank of England and the rest of the London bullion market stock. And it seems very clear that once you remove the ETF stocks from
the exchange-traded funds.
Yes, the metal that they purport to have. That basically you're ending up with a free float of as near zero as one could imagine. And of course, this brings up the question of what's really going on with both sovereign reserves and also the unallocated system, because the LBMA state our allocated system is X size and the unallocated system is far, far bigger, although we don't know quite how big. And the reason why I say it doesn't matter until it does, both the futures market and the over-the-counter, the spot market, appear to be showing signs of stress with this float. And I think that it's fair to say at some point someone will ask for delivery of a substantial amount, and then we'll probably see a delay in delivery, and that would create knock-on effects. It's very difficult to time it, Max, but I think it's very interesting at the moment, particularly interesting at the moment.
Well, the Queen just celebrated how many years on the throne? 60-something years? 70?
Pass.
I mean, she was very successful in perpetuating the reign of the British monarchy. Will we have to wait something like that, 60 years?
Well,
I don't know. I don't see there's necessarily how I connected those two, except that she's in the news. But my point is this what we're waiting for? Will I be dead and buried?
No, I don't think so. And also, someone I can't remember who it was yesterday, tweeted about the Queen and showed that how the pound has depreciated 95% during her reign, which I thought was probably the most pertinent piece of information about yesterday, actually, if you're interested in these kinds of subjects. So no, I don't think 60 years is probably realistic on the basis of
I can't talk too
rate.
much smack against the Queen because my mom really loves her. I think they're about the same age now.
Right.
So she's all rooting for the Queen, like, yeah, go for it, baby. That shows the power to the septuagenarians.
Well, it takes two to make a market, Max.
Yeah, well, we're going to keep you on for a second segment to dig even deeper into this into this kind of Alice in Wonderland market that chokes us gold enthusiasts, and we have to put up with the onslaught of those. I mean, being called a gold bug is bad enough, but referring to gold bricks as pet rocks, I mean, this is beyond the pale. I believe this came out of the Warren Buffett, Charlie Munger camp, I think. But why? Well, how can they get? Don't you feel your stomach turns a little bit when some big financier like that is referring to our life's work as a pet rock?
I think I'd be more worried if they were just baffled. I think there's an obvious sort of propaganda angle coming from certain parties. That doesn't worry me so much. I think
because they're very much invested in the financialization world.
Exactly right. You know, the thing people don't really.
Right, hold on, we got to cut up there. We're gonna come back and pick up on part 2. But I must say, all right, goodbye at the moment. So that's it for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Ned Naylor Leyland of Old Mutual Global Investors. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.